EPK Capital Present, Building Wealth for Generations. You're sitting at your desk abroad, life is good. But there's this nagging question that won't leave you alone. Where should I invest that $1 million I've saved up? You've heard stories from friends, cousins, maybe even your parents back home. Some swear by real estate in Mumbai, others rave about the stock market. But then someone mentions bonds, tax free bonds, and suddenly you think, that sounds safe, that sounds boring, but safe. The truth? It's far more nuanced than that. And honestly, most NRIs are making some serious mistakes when it comes to bonds and fixed income investments that are quietly eating away at their wealth. Hello everyone. Welcome to EPK Capital. Here we simplify wealth management and investments so you can build wealth for generations. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. Today, I want to walk you through this systematically. Think of this as the conversation you should have had with a proper wealth manager years ago. What types of bonds can you actually invest in? Let's start with the basics. When you're an NRI, you have access to several types of bonds. This isn't your average bank savings account situation. There's actually quite a bit available to you. First, there are government securities or G-Secs. These are direct debt instruments issued by the Indian government. They're issued by the Reserve Bank of India. When you buy a 10-year government security right now, in December 2025, you're looking at yields around 6.59%. If you're willing to lock your money for longer, say 30 years, you get around 7.32% annually. Now, that might not sound spectacular, but here's where it gets interesting. These are backed by the Indian government. The default risk is essentially zero. We are talking about the safest possible investment in India. Then there are PSU tax-free bonds. This is where things get juicy. These bonds were issued by public sector undertakings companies like NHAI, REC, and PFC between 2011 and 2016. The Indian government stopped issuing new ones in 2016, which is actually a big deal. It means they're rare now. Here's the kicker, the interest income on these bonds is completely tax-free. Let me give you a concrete example. Say you're in a 30% tax bracket, which most high-earning NRIs are. A PSU tax-free bond offering 5.5% annual returns is equivalent to earning 7.86% on a regular taxable bond. That's a significant boost. But, and this is important, you can't buy new ones. You can only buy them on the secondary market, which means they're trading at a premium, typically 10 to 15% above face value. So the effective yield comes down to around 5.5 to 6.5% after accounting for that premium. Then there's something many NRIs overlook, infrastructure bonds. These are issued by government-approved institutions like LIC or IFCI specifically for infrastructure projects. Now, most Indians can deduct up to 20,000 rupees invested in these bonds under Section 80 CCF. This is additional to the regular 1.5 lakh rupees deduction under Section 80C. Here's where most NRIs stumble badly, and I mean badly. Before you invest a single rupee in any bond or fixed income instrument, you need to understand the difference between NRE and NRO accounts. Most NRIs get this wrong, and it costs them thousands in unnecessary taxes. NRE means non-resident external. Here's what you need to know. Any interest earned in an NRE account is completely tax-free in India. Not partially. Completely. 0% tax. But there's a catch. Only funds that come from outside India can go into an NRE account. If you're earning in Singapore and sending money back to India into an NRE account, perfect. No tax. I want to talk about something that might make you uncomfortable. It's the biggest mistake I see NRIs make. And it's often not even about bonds specifically. It's about a broader misconception about what safe investing really means. Here's the scenario I see repeatedly. An NRI could, let's say they've got $1 million their risk covers. They've worked hard. They don't want to lose money. So they do this. They put 70, 80, sometimes even 90% of their money into fixed income. Fixed deposits, bonds, government securities. They think they're being prudent. They think they're being smart. Boring, but smart. They're actually making a critical error. Let me explain with real numbers. Right now in December 2025, the best NRE fixed deposit rates in India are around 6 to 7% per annum. Some might offer slightly more. Now, what's inflation in India right now? It's running between 2 and 4% annually. So your real return, that's your actual purchasing power increase, is around to 2-4% per year. That's it. Here's another major source of confusion and mistakes: repatriation limits. You've made money. You've paid your taxes. Now you want to bring it back to Singapore or Dubai or the US or wherever you live. Simple, right? Not quite. If you invested through an NRE account, repatriation is unlimited. No ceiling. You can send out $10 million if you want. No questions asked. This is one of the genuine advantages of NRE accounts. But if you invested through an NRO account, and many NRIs do because they have Indian income, you're limited to $1 million per financial year. Full stop. Let me get to the core question that brought you here. Are Indian bonds a good investment for NRIs? The answer is nuanced, as many good financial answers are. Bonds should be part of your portfolio, but not the whole portfolio. For someone with $1 million or more in liquid wealth, bonds are excellent for stability and predictability. They provide a known return, no surprises. That's valuable psychologically. Diversification away from equities. If half your wealth is in stocks back home and in India, bonds provide balance. Passive income without effort. You invest, you get interest. No stock picking, no market watching. Tax efficiency with proper planning. A 6.5% tax-free return through NRE is better than many alternatives. But bonds should not be your entire portfolio. That's wealth preservation at best, wealth erosion in real terms at worst. Your only India investment. India is growing. There are growth opportunities worth taking calculated risks on. Let me quickly debunk some myths I hear often. Myth 1. Bonds are completely safe, so I should put all my money there. Myth 2. Tax-free bonds are a steal and I should load up on them. Myth 3. I can invest unlimited amounts in bonds. Myth 4. Interest I earned is paid in my account automatically and I don't need to do anything else. Myth 5. Since I'm an NRI, I can't invest in anything good in India. So, where do you go from here? If you're just starting out with bonds, understand your account structure first. NRE or NRO? DTA applicable? Get clarity before you invest. If you already have bond investments, review them. Are they positioned optimally? Are you claiming all available tax benefits? Are you properly diversified? Many NRIs discover their portfolios are not structured as they thought. If you're serious about building wealth as an NRI, and given that you might have $1 million or more in liquid capital, I assume the conversation needs to be bigger than just bonds. It needs to be about account structure and tax optimization, portfolio diversification across growth, income, and alternatives, currency risk management, repatriation planning, compliance automation, and periodic review and rebalancing. If you'd like to have that conversation, if you'd like a comprehensive review of your current structure or help building one from scratch, that's exactly what we do at EPK Capital. And we help you navigate this so you're not making the same mistakes that most NRIs make. If that resonates with you, reach out. Let's have a conversation. I am Kunal. Thanks for watching.